what do you do with your mortgage rates? We got variable rates on the rise. We've got fixed rates. Clients are asking us, and I always say, I don't know. Talk to Zach Silverman at the Silverman Mortgage Group. So we're here to have a quick chat with Zach today on the mortgage rates, the market out there, and what's going on, and what he's telling his clients to do. How's it going, buddy?
Doing well. How are you?
Good.
Yeah, so Scott and I talked last week about setting something up because us as well with our databases, we've never had more clients and more friends and family reach out and say, what do I do? Either I'm on a variable and I've been on this roller coaster that's only gone one way for a year now, and I want off this roller coaster. How do I do that? Is it worth it? What are the ramifications? And then also people that are up for renewal this year, because the market was so busy in the last 5 years, there's lots of people up for renewal this year as well. And what do I do? I don't, with fixed money, 5-year money is in the kind of the 5.25, 5.5, maybe below that a little bit, but in that range. Do I want to lock in for 5 years at these rates, or are the rates going to go down? So,
So just the fixed rates. So if you take a 2 or 3 year or a 5 year, right now those are lower, you're saying, than the variable rate is right now.
Yeah. Everything seems to be backwards today. So variables prime is now at 6.7% in Canada. So anyone with the variables anywhere kind of between 5.7 and 6.7, really, depending on what the discounts were when you got your variable.
Right.
And so with fixed rates where they're at right now, typically what we see in a traditional market is shorter term fixed rates are lower rates than like a 5-year, then 7-year, 10-year are the highest rates. Well, because of where we're at in the marketplace right now, and they're pricing in that we're kind of at or nearing the top of the rate hike cycle, and that rates will come down. When and by how much, nobody knows. But because of that, and we know that rates will likely be lower in the future, we're actually seeing short-term fixed rates today being higher than 5-year fixed rates. And that's because banks right now know that likely if you lock into a 5-year fix, you're probably going to be paying a higher rate than if you do what I'm calling kind of a bridge term in a 2 or 3-year fixed, so that when rates are down, hopefully in the next 2 or 3 years, you're then renewing it at a significantly lower rate than today's elevated rates.
Interesting.
So, I mean, what I can do is let me just share my screen with you, Scott, and I'll show you a quick economic forecast from TD, and then a couple of quick reports that might help people and provide some clarity. Okay. So, are you seeing it all right here?
Yeah, got it.
Okay, so this is TD's economic report, and there's several, each big bank in Canada typically prepares, but this one was done on February 6th. So it's fairly recent. You can see that by their spot rates here. So a couple of things you want to look at. The overnight target rate is directly correlated to prime. So that would be the same as prime, but it's the overnight rate. So right now the prime is 6.7. You can see here that this is 2023. We are still in the first quarter. So as of February 6th, a couple weeks ago now, the TD is looking like prime will stay where it's at for the next couple of quarters, and then it'll actually go down in the fourth quarter of this year. Now, nobody knows this is, I mean, economists get it wrong all the time. So take this with a grain of salt. But what's more important is to look at, in my opinion, is to look at the trajectory where we look into next year and we see rates continue to go down by another 0.5% in the first quarter, another 0.5% in the second quarter, and then kind of keep going down. So we can see that rates will drop by the end of 24, not they will, but the economists are predicting that they could, by 2.25%. So that would be directly related to prime rate. That means prime would go down by 2.25%. So instead of 6.7% today, we're looking at 4.45 type thing. So much more manageable. And then when we look at fixed rates, if you guys have heard me talk before, fixed rates aren't exactly correlated to the bond yields in Canada, but very closely. And so 5-year being the most popular in Canada by far, you can see that as of February 6th, they were at 3.16. They've actually gone up since then because we had some employment data come out in Canada in the last week that was significantly stronger than we were expecting. So bond yields have gone up since then. They're about 3.5, 3.55, something like that. So that'll give you a really good idea. Today, 316, and then as we look at 23, the rest of the year, they're going to continue to go down and trend down slightly and continue doing so next year. So that would, these bond yields, depending on what's going on in the market, the spread can be anywhere from basically call it 1.5% type thing to 2% if the markets are tight. So that would put our fixed money in the high 3s to low to 4% type thing by the end of 24.
So
which
for
is
like a 5-year fixed mortgage, you'd be paying around 4% if this forecast kind of held.
Yeah, exactly. So at least that gives some, and again, let's not take this as gospel. Like the economists get it wrong all the time.
You said it. You said it. It's a guaranteed rate, right?
That's right. Yeah. So, and the reason this is important is because this must reflect what your strategy is today. If you're looking at, hey, I want to look at refinancing. I want to get off a variable train. I have a renewal upcoming, or I'm looking to purchase or move or buy an investment. This is all you need to have a proper strategy, and no longer walking into a bank and saying, what's your best 5-year fixed rate? It's not a strategy, right? So if you are looking at 5-year fixed, going eyes wide open, you're doing so for peace of mind long-term, really, but you're likely going to pay a premium.
Right.
Okay. The last thing that I wanted to touch on quickly, and I won't go through it, but we will link to the reports in the email that goes out.
If you're watching this, I'll have some links, whether it's on Facebook or I know we're gonna send this to all of our past clients because I know we'll be getting questions, but we'll have links to this stuff too. So
yeah, so we've just done a couple reports which I'll link to as well, and then there will also be I'll give Scott basically a link to our website that you can, if you want us to help you manage your mortgage or run this exact report for you, there will be a very simple intake form that you can provide that information, and we can just build up these types of reports for you. So this is basically a cash flow reamortization situation. If for somebody that's in a variable today with a $450,000 mortgage, somebody that's been in that variable for a year and a half or so. Anyways, I'm not going to go through all the details, but the strategy here is to go into a fixed term at 4.99. As I mentioned, rates have gone up since we prepared to do this call last week, but I do think that they'll come back down to 4.99. But as of today, they've gone up to 5.34 type thing. But you can see in this situation that the monthly payment is significantly lower, $483 a month lower. And the savings within that 33 months would be interest savings from the lower interest rate of $7,000. So there are savings out there. And again, I'll let you look at this report. You'll have access to it. And then again, if you want to have us run that scenario for you guys, then we can certainly do so.
So what would be the downside of doing that? I know like over the years, you've always said, I mean, I've got a variable rate mortgage, which I think the pro on that is it's easy to get out of. So if all of a sudden life happens, hey, we're selling the house, you got 3 months interest, you're out. But if you lock into a 3-year fixed, you may have a potential penalty there if something happens and you got to move before 3 years, right?
Yeah, so that's one downside risk is, and I'm not, listen, this isn't a suggestion that everybody should be converting their variable to fixed right now. This is just, I know there are people, because we have these conversations every day with our clients that are saying, hey, I can't do this anymore. I want off the variable train. And so this is an option. And so, yeah, the one would be the penalty has a potential to be higher if you pay your mortgage out within that term. And then the other one being that, hey, what if in 2 or 3 years times, the interest rates are still elevated? That's really not as much of a factor because you can see in those examples that we've saved all of that. You've saved your penalty that you're going to have today to do that. As well as interest costs. So you're kind of got to win there no matter what. So the penalty in a fixed mortgage is the big one for sure.
Yeah, cool. Okay, well, yeah, I mean, that's some good information. I mean, I know a lot of people are concerned out there, so that's, one potential solution, right? If you're looking to get a bit of certainty in what you owe on your mortgage every month, and potentially saving some money over the 3 years there, right? So
absolutely, yeah.
Cool. Anything else? What else is going on out there?
We've definitely picked up in activity with people. There seems to be a little bit more stability in the market on our end. There's starting to be a little bit more confidence that we're kind of nearing. Not it's impossible to time the market, as you know. So
Yeah.
who knows when the bottom is? But there seems to be more and more confidence that, hey, let's start looking right now and let's see what's out there. So that's positive to see.
Yeah, and we're the same, right? I mean, what your business is doing is reflective of ours, and I mean, there's a lot of buyers out there all of a sudden since we turned into 2023 here. We're getting multiple offers on things, and it's kind of back to craziness. A lot of that's due to limited supply out there, but the buyers are back out and realizing hey, that house that used to be $1.7 million is now $1.2 million. Even at the higher interest rate. You're saving yourself 500,000 in that example, and your payments probably around the same.
Yeah.
So that's another video we can do, right? Just showing people how the payments and whatnot work out, because if you can get approved, it's a good time right now.
Yeah, I think the one key that this is telling us is there's absolutely that pent up demand still. Whether you agree with it, disagree with what's going on in the market. Yeah, our market here locally is absolutely, there are a lot of people that still are wanting and waiting and looking for something to buy. So I think that's here to stay.
Yeah. Awesome. Well, it's great info, buddy. I will send this out to our clients, and we'll get this on Facebook and a few other spots. And send me those links, and we'll if anyone has any more questions, we'll have Zach's contact info there. You can contact him and his team, and they're great. They did my mortgage, so that's telling you something. I don't trust a lot of people with that stuff. So
thanks, Cody. Thanks for having me.
Okay, man. Have a good day.
All right. Yeah, you too. Chat soon.